One risk to Bitcoin is that we see the pro-crypto regulatory environment in Washington shift to an anti-crypto regulatory environment in a future administration. I think the fact that BlackRock is in the market and their most profitable ETF is their Bitcoin ETF reduces the probability of that shift, right? So you want high quality firms that believe in Bitcoin on your side with weight to sort of make sure that we don't swing too far in the event of a future election to an anti-crypto moment. And so for that reason, I also really welcome them.
Bitcoin hasn't even had its real melt-up yet. That's the warning from Matt Hougan, who says institutional demand is quietly building while supply keeps shrinking. Just like gold exploded after years of steady buying, Hougan believes Bitcoin could eventually face a massive supply shock, and when sellers finally run out, the next phase could be absolutely parabolic. So why are Wall Street giants suddenly rushing into Bitcoin now? Even more interesting is what happened during Bitcoin's correction periods. When Bitcoin retraced roughly 50% from its highs, ETF investors barely sold. Outflows remained surprisingly small. Hougan says this shocked many observers because historically, Bitcoin investors panicked during major drawdowns. Instead, ETF buyers demonstrated what he called diamond hands. That signals something extremely important. Institutional investors may have a much longer time horizon than traditional retail traders. And that changes everything.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Or a very bullish Bitcoin environment. Remember, we haven't seen like a 2017 melt up in Bitcoin. What we've seen is the market has roughly doubled since the Bitcoin ETF launched, or gone up 60%, but that's pretty pedestrian returns. And, a really interesting thing that we've seen is that not much money flew out from the October high to the February low. Bitcoin retraced 50%. We only had a few $1 billion of outflows. That didn't surprise me, but I think that surprised a lot of people that the buyers were such diamond hands in these ETF markets. The thing people forget about that gold bull run, which took place in 2025, right, particularly the second half, is that actually it was at the end of a grind. So the gold bull market started in 2022, actually, when the US seized Russia's treasury assets after the start of the Russia-Ukraine war. That caused central bank buying in gold to rise by 150% on reported terms and probably like 300 or 400% on real terms, because a lot of it doesn't get reported, particularly from China. And gold went up a little bit in 2022. But then that central bank buying persisted in 23, and gold went up a little bit more. And in 24, and gold went up a little bit more. And then in 25, it persisted again. It didn't increase; it just sat at about 150% above baseline. It sort of sat. But it was only in 2025 that we had that melt up, and that tells you something. What it tells you is that the gold market had residual supply that was willing to sell to central banks. And they sold in 22, and they sold in 23, and they sold in 24. And then in 25, they ran out of gold to sell. And there was a supply shock where the central banks were still buying, but the sellers were exhausted. And that's where you get that parabolic move. I actually think that will happen in Bitcoin eventually, because you have this institutional demand that's come in and is buying tens of billions of dollars of Bitcoin. And so far, people have been willing to sell. And they're still, to some degree, willing to sell. But I have a view that this institutional bid is going to persist for 5-10 years. I think it's going to accelerate, actually, as these platforms get more comfortable around Bitcoin. And so I actually think it's just a matter of time. I think gold tells the story, which is it's not like demand spiked in 2025. Demand was persistent. It's actually that supply ran out of gold to sell. And I think that will eventually happen in Bitcoin. I do think we'll eventually get to melt up. I don't know when that will happen, but I think if we see this persistent institutional demand, I think the story we saw in gold will repeat itself in Bitcoin, actually. So is it frustrating that Bitwise was in the market for 6 years and then BlackRock came in and swooped up huge amounts of assets? Of course it is. but my firm's assets are up, I think, 10 to 15x since BlackRock came into the market because they widen the pie dramatically, right? So they bring so much credibility to the space, and they have conversations and we have conversations that we get a piece of that and they get a large piece of that. And they're such a high quality firm that I love competing with them. I know that they win a lot of time because they have brand, but they really are growing the pie significantly. The other thing that I think about, one risk to Bitcoin is that we see the pro-crypto regulatory environment in Washington shift to an anti-crypto regulatory environment in a future administration. I think the fact that BlackRock is in the market and their most profitable ETF is their Bitcoin ETF reduces the probability of that shift, right? So you want high quality firms that believe in Bitcoin on your side with weight to sort of make sure that we don't swing too far in the event of a future election to an anti-crypto moment. And so for that reason, I also really welcome them. So I love competing with them. I get frustrated sometimes, but we're growing the pie. And so they're our friends, and I'm glad they're in the market. Well, there are three ways to get them interested in Bitcoin, and you sort of have to figure out who you're talking to because they'll have different views. And maybe I'll walk you through those three ways. There's one group where you can make just a sort of Jack Bogle argument, which is to say, look, Bitcoin's a $2 trillion asset. Equities are $110 trillion. That means you should be about 1.8, 1.9% Bitcoin if you're neutral. If you're at zero, you're off market. Look, Schwab is talking about 7% Bitcoin. Fidelity is saying 10%. My personal portfolio is like a third. You don't have to do that. Let's just get to neutral. If you want to be underweight, maybe you're at 1%. And so there's an audience that really believes in diversification. And if you know that that's the type of advisor, that's an angle you can go. There's another audience that really loves portfolio construction, and they're into Sharpe ratios and drawdowns and how to improve the risk-adjusted returns of your portfolio. And the amazing thing about Bitcoin is you can walk through studies that show that over any 3-year period in history, every single 3-year period in history, every whatever that is, 1,000x days, Bitcoin has improved your risk-adjusted returns. And even a small allocation has done so without increasing your volatility. And that you can have a great sort of science-based conversation that says, if you strip Bitcoin of all the emotional baggage and just look at it as an asset, you want it in your portfolio. Not 30%, that's for yahoos like me, but at handfuls of percent, you can really have a risk. And then there's the third group where they're very interested in asymmetric returns, and they're looking for things that can really provide upside to the rest of a portfolio that's relatively conservative. And there you can walk them through, like I love to walk them through why I think Bitcoin will get to $1.4 million by 2035. And there's some very facts-based reasons with some very modest assumptions that get you to those kinds of numbers. And so if they're an asymmetric return kind of a group, then you have to target them. Sometimes you pick the wrong lane and you think they're an asymmetric group and they're actually this Jack Bogle style investor. But we sort of have different approaches for each kind of institution. And usually one of those three things at least opens the aperture to get them to start to consider it.
Another important point Hougan addresses is competition from giant firms like BlackRock. Many crypto-native companies initially feared firms like BlackRock would dominate the ETF market and crush smaller players. But Hougan argues the opposite happened. Yes, BlackRock captured enormous inflows, but their participation also massively expanded the legitimacy of Bitcoin. When the world's largest asset manager launches a Bitcoin ETF, it sends a message to pension funds, advisors, banks, and institutions everywhere. Bitcoin is no longer fringe. BlackRock's involvement has effectively normalized Bitcoin in traditional finance. Hougan says this grows the pie for everyone in the industry because institutional investors who previously ignored crypto are now willing to take meetings, study the asset, and consider allocations. He also highlights another major benefit that most investors overlook: political protection. If a future administration becomes hostile toward crypto again, large firms like BlackRock now have enormous financial incentives to defend the industry. Their Bitcoin ETFs have become highly profitable products. That means Bitcoin now has powerful allies inside traditional finance. And according to Hougan, That significantly reduces the probability of an extreme anti-crypto crackdown in the future.
It's improved a lot. So at this point, now that Morgan Stanley and Wells Fargo and Merrill Lynch have all greenlit Bitcoin exposure for their clients, it's the majority, but it's not everyone. There's probably 20%, 25% of the wealth advisory market that is still strictly closed to Bitcoin. But compared to where it was even a year ago, I would say that less than half of the market was open. And 2 years ago, it was like 10% of the market. So it's expanded dramatically. An important thing to recognize, though, is that that doesn't mean flows happen immediately. That analogy with Kathleen Moriarty, it's not like I put 10% of my portfolio in Bitcoin after I met with her, right? You started studying it. I've said this before, but for a while, our average client did 8 meetings with us before they allocated. If you think about the market just opened, let's say 6 months ago, and we meet with people quarterly, they're on meeting 2, right? So the flows you'll see from those people are 6 quarters away. And that's just the process. And it's easy for Bitcoiners to say you should get it immediately, but we all forget that very few of us, some people did, but very few of us read our first media report on Bitcoin and then smashed the buy button. We all wanted to do our work, and they're doing their work. They're just busy, so it takes them a while. Look, I think it got excited about the initial policy reset. You certainly saw that around the election, where we spiked from the 70s to 100K pretty much immediately. And like anything, I think it probably overestimated the short-term impact and underestimates the long-term impact, right? So we're following that traditional trough of disillusionment or whatever. It's really remarkable, the degree of change, right? I don't think people who weren't in crypto really reflect on how bad it was. So the new people entering Bitcoin don't recognize how bad it was during the Gensler era. It was hard for even big companies like Bitwise to get bank accounts. Like, imagine that world. Imagine having millions of dollars and going to a bank and then telling you, no, we don't want your money. That was a real lived experience for many crypto firms. And virtually every crypto firm faced lawsuits or subpoenas from the SEC. It was just exquisitely toxic. And now it's extraordinarily accommodative. The SEC is pro-crypto. The OCC is pro-crypto. The CFTC is pro-crypto. We're getting crypto bills passed. So my view is that the market did initially recognize the difference, but it doesn't necessarily understand that Washington takes a long time to change. And we're going to feel the impact of this regulatory shift, not over 5 months, but over 5 years. But it's really a different environment. I can't emphasize how toxic it was and how normal it feels now. I think it's really important. The other thing I'll say, which is maybe non-obvious to people, is that the improved regulatory environment will make crypto safer, and there'll be fewer blowups of the life of FTX or the ICO scams that set us back so much in crypto over the years. We're going to have fewer of those because we have an engaged regulator who is willing to work with high quality actors instead of just pushing everything to unmonitored offshore environments where craziness happens. And that means not no blowups in crypto. I don't think that will be the case, but fewer of those types of blowups in the future than we've had in the past. So when Bitwise was first founded, actually back in 2017, it was very hard to get a bank account as a crypto company. So literally imagine having the world's best VCs give you millions of dollars and going to banks and then saying, we don't want your money. That was a lived experience. And then during the Silicon Valley Bank, Silvergate Bank, Signature Bank sort of fiasco, where the government almost forced crypto-related banks to shut down, it was very challenging to find banks that were willing to do business with crypto firms. Obviously, Bitwise and others negotiated it, but I do worry about, I think there are probably a number of smaller crypto companies that couldn't negotiate that level of banking distrust. I do think regulators deliberately shut down Silvergate Bank and made Signature very difficult. And if you're another bank and you see that activity, do you really want to put your bank at risk? So yeah, it was a lot of work by the ops team to make sure there were not just a functioning bank, but a number of backups in case those functioning banks faced limits during that period. Yeah, it was mind blowing. I just think of banking like a utility, like water, right? Like imagine you can't get water to your house. What do you do? It's just like crazy world that we lived in during that period. It's a manageable upgrade problem. I think of it like any other problem, which is if you focus on it, you can resolve it. If you take the challenging steps, you can resolve it. I don't think Bitcoin should bury its head in the sand. I think quantum is real and will eventually get here. And while it doesn't threaten the core of Bitcoin, it does put things like Satoshi's wallets and other old wallets at risk that could disrupt the market. We should address those. We should give people a pathway that they can see in the future that will let them escape that quantum risk or at least mitigate its impact. So, it's like having high cholesterol. If you ignore it, it'll kill you. But if you treat it, you'll probably be fine. I think this is the same thing with quantum. It definitely comes up in conversations, and we like to walk people through a few things. So one, we like to walk through why it doesn't threaten the core of Bitcoin, the consensus mechanism. It threatens a portion of Bitcoin, because I think the popular conception is that quantum will just destroy Bitcoin writ large, and that's not the case. It will expose a large number of old wallets and a lot of Bitcoin to theft. And then we like to show them high quality reports by leading voices in Bitcoin that show that there is a pathway to deal with this. So SF Presidio, to call out one example, has a great report on this. And I think people come to understand that once you view the problem, understand the problem, and if the core devs address the problem, then we will get past it. But it does slow down institutional allocations. I do want to emphasize that. There are institutions that would allocate but for quantum risk, and they want to see more action from the community to have a clear roadmap for dealing with it. I think we've made a lot of progress in the last 6 months to getting to that roadmap, but we still have some way to go, and I do think it's weighing on the market.
Some investors simply care about market neutrality and diversification. For them, the argument is mathematical. Bitcoin is now a multi-trillion-dollar asset. Global equities are worth over $100 trillion. Therefore, a completely neutral portfolio should logically contain some Bitcoin exposure. Even a 1% or 2% allocation becomes rational under this framework. These investors may never become Bitcoin maximalists, but they don't want to remain completely exposed to a potentially transformative asset class. Another group focuses heavily on portfolio construction, Sharpe ratios, and risk-adjusted returns. For these investors, Bitcoin's historical data becomes extremely compelling. Hougan explains that over nearly every rolling 3-year period in Bitcoin's history, adding even a small Bitcoin allocation improved overall portfolio performance without dramatically increasing volatility. This transforms Bitcoin from a speculative gamble into a portfolio enhancement tool. Once emotional narratives are stripped away, institutions begin viewing Bitcoin the same way they would evaluate any other asset. And that mindset shift is incredibly important.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.